Hi guys, welcome to the first video of the series Learning Simplified. Through this series, we would understand complex financial concepts in an easy to understand method and demystify certain jargons. Most examples in the series are provided with the commercial bank as an example of an organization or business. Coming to the two most important financial statements which are generated from an organization, we have the profit and loss statement and the balance sheet. Now remember that any organization, when it does business, financial transactions are created. And all these financial transactions are recorded. These are recorded in a double entry system of bookkeeping, which means that for every transaction, there is a debit and a credit entry. More about that in a subsequent video. But for now, it should suffice that these financial transactions form the source of these two important financial statements. Now let's look a bit deeper at the P&L statement of the profit and loss. So first, the obvious question, why is it made? Of course, as the name suggests, it is to find out if the company has made a profit or loss. And it is important for the investors and shareholders to know how the company is running. And secondly, it is a legal requirement, especially if you're a listed company. So the company generates profit when its income exceeds expense. Now that's simple maths. So we are introduced to two jargons called income and expense, which we anyway use in our daily life. Income, it comes from the sales of goods and services, or in the context of a commercial bank, it is the interest the bank receives from loan provided to consumers, or maybe from its investment in mutual funds. Whereas the expense arise out of the salaries which the bank pays to its staff to pay the rent or electricity bills, or the interest the bank needs to pay to depositors. So in the scenario that the income exceeds the expense, a profit is made. An important thing to note is that a profit is for a given period, which means, for example, the P&L statement for the period April 1, 2019 to March 31st, 2020 is so and so. So that is a from date and a to date for a profit and loss statement. A simple table which depicts the P&L. On the left hand side, we have depicted the expenses, which could be under the heads of electricity bills, salaries, interest depositors. On the right hand side depicted are the incomes, which could be arising from sales of goods, interest the bank receives from loans they have given out, or interest from investment. And at the bottom we have the profit, which is income minus expense. So obviously if this is negative, which means the bank has made a loss. So at the top right, we have the income, which is known as the top line, to use a bit of jargon. And at the bottom, we have the profit, income minus expense, which is the bottom line, simply because it appears at the bottom. So one must remember that any business is not in the business to increase the top line. It is in the business to generate profit or making the bottom line healthy. So I think this depicts and makes it clear what is a top line and why it is called a top line, and what is a bottom line and why it is referred as a bottom line. Coming to the second most important statement, the balance sheet. First question again arises, why is it made? Of course, it is to find out the health of a business. Now, the P&L statement also is made to find out the health of a business. So why again a balance sheet? We'll find out more in the subsequent slides. Secondly, as in the P&L statement, this is a legal requirement. Now, what comprises a balance sheet? The P&L was based out of income and expense, whereas the balance sheet is based on assets and liabilities. And it is prepared as of a given date, unlike that of a P&L. So example, balance sheet for the period ending March 31st, 2020. Unlike P&L, it doesn't have a from or a to date. It has an ending date only. So let's find out more about the assets. So assets represents what it owns, what the organization owns in terms of land, building, or machines. Now these are termed fixed assets because they are immovable and they are fixed. Or in the context of a bank, it is a loan which the bank has provided to the customer. Or it could be simply the cash balance reserves, which are known as the current assets. The other head is the liabilities, which represents what it owes to others. It could be the capital which the owners contribute to the business. Why capital is a liability? Because the business is liable to return it back to the shareholder or the owner who was contributed when the business was started. The other head could be savings or fixed deposits of customers in case of a bank. So now we know what is an asset, what is a liability. In simple terms, liabilities are what we owe, assets what the business owns. So again, depicting like in the P&L format, on the left hand side we have the capital, the savings account balances, the fixed deposits of customers. I'm speaking in terms of a bank being the organization. On the right we have the overdraft balance of current account. Current account, if the balance goes negative, it means that bank owns that money. Similarly, when a bank provides a loan to the customer, it is the money which belongs to the bank and hence it is an asset. Thirdly, it is the cash balance, which is the reserves or the extra surplus cash which an organization may have. So at the bottom, I'm trying to do a net just like I did it in the P&L statement. Liabilities minus assets. But this always results in zero, since balance sheet is always balanced, which means liabilities is always equal to assets. Now, surprisingly, why is it always the case? Why liabilities and assets always balance each other? Let's find out. Let's try to understand why the balance sheet balances. So some say that it balances because they are prepared from a double entry bookkeeping system, where every transaction is represented by a debit and an equal credit. The answer may seem confusing, but there's a simpler explanation for the same. Now, assets, apart from representing what it owns, it also represents the usage of funds. It tells us where the money was spent for owning that asset. Similarly, liabilities, apart from representing what it owes, it also represents the source of funds. It tells us where the money was obtained or borrowed. Since sources of funds are always equal to the usage of funds, the balance sheet will always balance. Since what you get, you need to spend or keep it in cash reserve. So to depict in a simple example, I started a bank with a capital of 10 million, which is a liability since the bank owes me that money. On the right hand side, I used that capital to buy a building and buy servers to the tune of 6 million, and the remaining 4 million I kept it as reserve. So as you can see, at this stage liabilities equal assets. The balance sheet size is 10 million. As the bank grows, we customers bring in funds. So 5 customers have brought in funds to the tune of 2 million. So that's a source of fund for the bank. So the balance sheet size has increased to 12 million. The cash balance has increased now because of this extra 2 million from 4 to 6. The extra surplus money, the bank decides to give loan to 2 customers to the tune of 3 million. So the loans asset head increases to 3 million. The cash balance reduces from 6 to 3. So here the balance sheet size remains at 12. It's only the asset heads which got rejigged a bit. At this stage as well, the liabilities equal the assets. Now to understand why the balance sheet is required to be made, first of course it's a legal requirement just like in the P&L case. Secondly, it actually tells you the quality of the source of funds. Who is bringing in the money? Is it the low cost owners fund or is it the high cost funds from an outsider bank or an investment banker? Secondly, it tells you the quality of the use of funds. what are the kind of assets which are being bought by the money? Are those assets essential for the running of the business, or they are auxiliary or luxury items meant for the business? I hope this session has been useful to understand the concept of balance sheet. Coming up would be an in-depth look at how the double entry accounting system works, how a debit and a credit is made to a financial transaction. Thank you.